in terms of what you said, the key points there are the how much earnings continue to beat expectations. I think that should be a positive sign for us in terms of what the trend will be like for earnings going forward, because we know that we've gotten these stellar results, but they've also come off the base effects, the poor period that we had last year. But this means that we should continue to see earnings rise higher, and that equity multiples are actually coming in as they have been throughout 2021, despite this explosive earnings growth. So this doesn't leave us, pounding the table saying it's a great place to add to equity risk, but it does tell us that equities are still the place to be relative to rates and relative to credit. Just because if you look around at the asset classes, at the broader spectrum, which we of course do in multi-asset portfolios, the message that the bond market is sending us is fairly a negative one when it comes to the outlook for nominal growth over the next 2 to 5 years, whereas the message from corporate executives is just one where we are going to get this handoff from kind of the income support measures, from fiscal stimulus over to a more corporate-led private sector recovery.
That said, corporates failed to see the collapse in demand at the start of the pandemic, and many were just looking at the supply side chain and trying to manage what they had there in terms of costs and inputs into the business, and then demand fell off a cliff. This time round, are they too optimistic? Are they not seeing that potentially around the corner as the Delta variant impacts a lot of the strategies companies have, a lot of the strategies that were being deployed to bring workers back into offices? That's all changing now, and doesn't that change the trajectory around growth?
So what I will say is that based on what corporates were saying is that the Delta variant is certainly a risk, but at this juncture, and remember we were getting these reports into last week, so into a time period where you could have seen if there were any nascent effects on your business and on demand. They were saying that it was not yet cause to trim guidance, to lower guidance, or to massage that down in any way. So I guess the flip side of that is precisely your point. Whenever you have something that's a risk that you're not using to mark down numbers now, then that's certainly a cause to be potentially adjusting them lower. However, some of the companies that you would suspect to be in the most affected industries, mainly airlines, stand out. We're saying that bookings continue to be quite strong, and they had also said that throughout this pandemic, and as you've had flare-ups, generally the news sentiment will then feed into whether there's no-shows, whether there's cancellations, whether bookings start to take a bit of a hit. But recently, there's been a bit of a delinking between that, and I think this is something that central bankers are also telling us, that there's throughout this Delta wave and the spread of it, there's been somewhat of less sensitivity on the growth and demand outlook, just because we do have vaccines now, and we do have a period of a year of learning how to live and manage around the risks to public health while still kind of maintaining a base level of production and activity.
Lucas, just to drag you back to the inflation question, we just had a 9% factory gate print in China on inflation. CPI looked a little bit more benign, but with that price at factory gates, aren't we going to be importing inflation into the Western economy, or exporting inflation from China ultimately? And what do you think the consequences of higher inflation prints are going to be on equity investor sentiment?
I think the key question, and it's precisely how you kind of phrased it and set it up there, it's what's happening to the input prices versus the output prices, because you're going to have disparity between regions and even within sectors in certain regions. And what we've been seeing is specifically in the US, is that throughout this earnings season, right, the big story has been inflation, input costs, supply chain stress, labor costs rising. Will companies be able to handle that? Will there be a hit to margins? So far, the story is that earnings are surprising more to the upside than even the revenue picture is. So that's not telling us that companies are currently facing margin stress, but that's the key picture to watch going forward. Whether you're continuing to see what you have in China, which is that kind of more that margin compression story, is what's implied by the input prices rising much faster than CPI, or whether you start to have more of what's in the US, can that continue? The margins holding up because companies are able to pass things through. But here's kind of the sticking point to that, or the limit to it, even within kind of the markets that have been able to hold up better on the margin side so far. If you're able to pass along inflation, well, that means that eventually, and probably sooner than would otherwise be expected, then you're going to have to reach that point where central banks do start to get a little little more urgency on removing accommodations. So there might be some kind of a trade-off here where you have to either sacrifice somewhat on margins, or you're going to have to sacrifice on the degree of monetary policy support that's helping to underwrite markets.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.